Hi, this is Rohit Srivastav, and I'm recording for the 13th of November 2016 at the end of what has been not just an interesting week but a developing 2 months. And there are so many things that kept adding up that needed to be spoken about over the last couple of weeks. I think I did a video cast more than almost a week back, and that audio cast essentially explained my views on the dollar and some of the events that had already happened, but a lot more has really transpired. So I think I'll try and cover what I've done. I think this could be a little long on the video, but if I can just speak up quickly, I think we'll do it faster. So starting right away, I think the market peaked in terms of the Nifty in the first week of September. Okay, and then we've been seeing a sliding index since then, making lower tops and lower bottoms. Now, what was interesting is since then, while I did think that we'd completed three waves, we closed down for the month of September as well. And that marked the completion of a potential move. But once we hit 8,500 and started bouncing back, the small cap indices hit another new high. And so that once again raised the question that, are we being wrongly bearish early again, and for someone who's thought that this market is a bear market rally and will not continue endlessly, every time the market's extended a little beyond my level, when it happens once, twice, thrice, the third time you start do you take a step back and say, okay, is something else also possible? And essentially, this has been the one time where everything else that happened against bearish views over the last 2 years at the two major tops, each of those things didn't work. So let me go over them. The first thing that happened is the index actually broke its rising channel. The Nifty itself, even while the other indices were continuing. And last week, just before the Trump election, the small cap and mid cap indices started to give up and fell for 3 consecutive days in the week prior to the election week. And in doing so, they actually broke their rising channels as well. Now, when something like a move happens only because of an event, also you start doubting, whether the move is actually serious, even though in terms of the break, irrespective of what news or event caused it, it is a serious break. But events do cause reactions that can be false alarms, and so it meant waiting a couple of days to see, whether the previous highs could get taken out, or whether you start breaking other averages. But if you purely go by the Nifty, it broke those channel lines much before. And having peaked more than a month earlier, this was already a trend in force. So whatever we are seeing happen right now in the last week is essentially a continuation of that trend, is how we would look at it. And each of these event reactions is part of the trend down that has already started quite a while back. And the reason these events would happen is, there's been enough talk from the US side, which was anti globalization in a way, basically a talk against various free trade agreements or outsourcing and so on, which had emerging markets concerned in a way. But before I get to more of what the US means, what this whole thing, at least for India, looks like is, as though you were, you're just waiting for this event to get over, very similar to, 2008, you were waiting for maybe the Reliance IPO to get over, and then the markets fell off, but that was not the core event. You had world markets falling anyway, but then our own market held on till, you completed certain things. And so probably after all the events of the last several months, like Brexit and so on, this was one more event that you were simply waiting to get after, go before, before you really take a significant view. Because even when Brexit happened, it looked like you were starting to break certain levels. You had some ending patterns on the Nifty. But the broad market continued to extend itself. Most global markets bounced back from that, though apart from the FTSE, none of the other, European and other markets made major headways. And after that rally, they more or less remained in a very, very narrow range. So this was the next big event, and now that it's behind us, we are looking at the index having broken several levels. And purely talking about the Nifty, because the Nifty last year in 2015, after when we were expecting a top for several months, several negative divergences, it kept taking support on the 20 week average and extending to one more new high. with multiple divergences till it finally peaked in March of 2015. So the 20-week average became one level that I'd want to wait and watch, and so 8500 is where it was when it bounced back just before the election week. And when that happened, I mean, I should say before Diwali. So when that happened, I thought maybe we'll do at least a 60% retracement, which meant 8800. The bank Nifty did do 61%, but Nifty itself did barely 50, and not going beyond maybe 8680 started to sell off again. So the first thing it did is it broke the 20-week average last week itself, along with the broad market giving up. And then again, because of the event, you'd wonder, should you wait? And the next thing that has happened, and it has happened this week, post-event, you saw the dramatic sell-off and bounce back. And so once it bounced back, you had this very big day candle, which most would observe as being a panic low, and you'll probably not break below that. But the key level that I'm watching for and was watching for, see, essentially sometimes when you get these big candles, you can look at the closing charts, which is what my analyst team started to do. And if I look at a closing chart, then what level would I look at on weekly charts? The next level would be, okay, look at the 40-week average. Some people look at the 50. So after this big bounce up, you'd probably think, well, it's not going to break that, because the 40, the weekly Bollinger Band, all sitting as supports close to 83.50 to 83.10. And we ended up closing below all of those levels. So that's again important, because many medium to longer term sell-offs, when they develop, you come close to the 40, and sometimes you may pause for a week, bounce back for a week, and then again they sell off and break that. So breaking this level again is another warning that the overall structure of the market is beginning to weaken. Now, having in the process of doing that, we also developed what would be a almost a 1 year long, I think, massive intermarket divergence between the mid and small cap indices, which have continued to make new record highs, and the Nifty itself, which has not managed to get past to a new high, which was 91116, which was made in March of 2016. Now, if you're following me, you would have seen I looked at intermarket divergences even in 2015. The mid-cap indices made new highs all the way till June of that year, even though the Nifty had already started to decline. And that itself was a sign for that period that you would sell off. Then in Feb, I expected a bear market rally, which would probably extend to 88,200. Best case scenario, I didn't think it would get to 87, 88. But even when it did that, and we'd only completed 3 waves and we closed down for September, which meant it still confirmed with my expectation that this was a corrective rise, it's not an impulse. People were still targeting 9,400 or 10,000 and all kinds of targets every time the market goes up. But again, this week we faltered. We've not managed to complete an impulse, and we have an even larger intermarket divergence with the broad market now almost a year long. And why do I keep talking about this intermarket divergence? If you're not tuned to the Dow theory, the very classic theory that started this entire field of having indices and then having technical analysis more than 100 years back, essentially found its basis in looking at things like the Dow transports and the industrials confirming each other on the way up in a bull market and on the way down in a bear market, or if not that, then with the utilities. And these divergences essentially were looked for to see whether the strength of the market was single sector or broad based. And I think that's the reason. That's a very it goes right back to the roots of how you look at markets. Now you can argue that all divergences don't work, and if you're looking at short-term divergences, which are a few days and few weeks apart, it's possible they break up. But when you get these bigger ones, which become multi-week, then multi-month, the implications are for a much longer time frame, and so you need to keep an eye on them and watch whether things are continuing as expected or the divergences are getting respected. And so far, for the nth time, I think we're seeing these divergences simply continue, and that, along with many indicators that I've published in the previous long short reports, long short updates, that ran right into bubble territory, kept breaking past each of these significant major tops that we've seen 2008, 2000, 1992, and I've shown those comparative charts of different indices and how they've really how we've really gotten into the same territory that we were in when many of those peaks occurred. But because this continued on a prolonged basis, some relative strength indicators overshot the ranges. It became a long wait to see to reverse, but essentially when you're there, you know that you're in heightened territory and you need to look for exits and not for entry points. And which is why I've really avoided looking at the investment side much, and really looking for more stocks that are topping, even though some of them did go wrong recently. The idea remains to be looking for topping structures, and you're actually seeing multi-week, rather I should say multi-year structures which have been developing, for the last 4 to 5 years complete, and despite signs that maybe they could turn into something more bullish, those trend lines which are touching all the highs of so many previous years have been respected again and again in several stocks. So that continues to again aid my macro picture of what the Indian market is doing. So this entire attempt to try and break out beyond 87, 8800 essentially has failed, not really worked out in this time period. And having broken so many channels, not just the Nifty, but now even the broader market, most weekly indicators remaining on the sell side, I think you need to remain prepared for what might continue to be a lower top, lower bottom kind of sell-off that will most likely continue in the weeks and months ahead. And so that brings us to the two major events that are hitting us in the current week, and so I think I should get to those. One of them, of course, was the US election, which was known months and months in advance, and it surprised so many, which is pretty amazing, because this is not the first time that polls have really gone wrong. They've gone wrong election after election. I think more significantly we saw it in the Modi election itself, where most polling agencies got it wrong, even though the activity online was so heightened and everybody gave credit to all the Twitter activity and online promotions that were done to really win that election. So having seen that, and then having seen what happened with Brexit, again similarly polls going wrong, and essentially if you look more closely, the ones who are getting it right, it was actually a Google poll that was looking at search words and how many people were following the events online to judge whether it would be a vote to leave or remain. And they were judging leave, even though the polls based on the old, and I should say even outdated methods of sample sizing and so on, which are taught in schools and really practiced throughout industry for so long. They probably work when you don't have major shifts, when everything is when the voting is along a certain line, then you're not having major shifts in the voting style, because you're only looking at a sample. A sample can get easily skewed, so as long as the voting remains within normal ranges, probably those sample sizes tend to show that maybe one or the other agency has got it right. But essentially when you have major swings happening, major changes in trend, then as we are seeing right now, none of these things work. And it's very similar to the same issue that we raise with economics and many other fundamental methods that are linear in their forecasting rather than non-linear, and not looking at things like rate of change and looking at sine curves rather than simply looking at a straight line. So the method of forecasting that you're really using comes into question. So the sample size itself can be small, but when in the online world now, the biggest disruptor is that you have access to millions of people who are online. They're saying things and you can read into what they're doing, and if you have the right technology to read into it, then you can actually have better result forecasting. And Google managed to do that for Brexit. And if you didn't note, there was a video, and I spoke about it in my Facebook post, which I saw from I think it's a website called Half Past Human or so. And essentially a week prior to the Trump election, he was talking of having run millions of the words that were used, he called it linguistic analytics, which is pretty different. And these online polls essentially of what people were saying and online were giving a completely different picture. They were saying that Trump is going to win with a significant majority, a landslide of sorts. And so once again, that proved to be more right than what most of the classical old school polling agencies were really trying to say. And also another thing that people look at, voting odds. So that again was interestingly brought out by in when the Brexit vote happened, that what you don't look at often is what is the size of voting taking place. Is the bet sizing, if you say that somebody is being voting in favor 4:1, but the votes in favor of 4 may be of a small number of people putting large sums of money, and so you're really not voting catching the numbers. You're really looking at odds based on the amount of money being put over there, and that can be skewed because election voting is essentially about numbers and not about size. It's not a weighted average. So well, we are done with that, and so depending on what you would have been looking at, you would have expected this outcome. The next funny thing was to people to expect that if Trump won, the U.S. markets would crash. Now, well, there can be negatives for the U.S., but essentially, if you listen to whatever he was saying, it was pro-US. I mean, he's talking of cutting taxes, he's talking of spending money month after month, day after day, and people were saying markets will crash, but essentially it's bad. It was specifically bad for, whatever he plans to do would be more negative for emerging markets, people who outsource, and essentially that hits more markets like India than anything else. But the real thing, I mean, that's just the upfront reading into what he's trying to say. What we don't know is what he'll actually end up doing. Now, of course, when you've come on the vote of a significant platform, you're going to try and attempt to implement some of that. For example, if people were not happy with inflation in India and they voted in that power, in my 2015 notes right after the Modi election, I kept saying that if your expectations for growth are based on government spending and inflation, and that's unlikely to happen. Growth would happen on its own forces, and in that sense, growth was already slowing in terms of earnings and various other factors. So that would not happen, and inflation was probably the only thing that the market was hoping for. And over the next 12 to 18 months, that turned out to be true. There was no more inflation. In fact, we've been trying to contain it, and that eventually caused the slowdown to just remain in terms of earnings. But the markets remained robust on the back of couple of factors. So the same thing applies to the US. There's a lot of hope. But what if I say that the US's infrastructure spending is not going to run into trillions of dollars, but just a few billions of dollars, something that we don't know, then the whole matrix of what you're really expecting can completely change. So versus expectations versus reality, how much of it is he's going to be able to push through with the Republicans into Parliament, because understand that while he may be an independent person with his own opinions, he's part of a party that may have multiple opinions. So they will implement things in a particular direction that he's won his platform on. The size and pace may vary. Because note that the immediate market reaction has been that, well, he's going to spend money that will cause growth. At the same time, it could be inflationary and cause interest rates to go up. The multi-phased impact of that was the market tried pricing all of that in at one go right away, as if it's happening today, like markets always do, being ahead of themselves. So initially you saw the rally in various commodities. You saw it happening even before the election, based on people who probably have bought into that theme. Buying of copper and various base metals was happening well ahead of the elections. And when the election results were out, you saw big moves in gold and silver essentially. And similarly, interest rates in terms of US bond yields were rising all the way from probably August or so, and the bond prices had been falling. By some time last week, the fall so far had been three waves and it was already getting oversold. So I started wondering whether you're going to see bond prices bounce back from there, because you hadn't completed a five wave, even though EWI put out a note saying that, well, they may have completed five waves and you'll see a bounce back. So I was coming to the same conclusion, because sentiment extremes and oversold readings were pointing that maybe we've completed something here. But bond prices started to fall again right after the election results, essentially on the same expectation that, well, more spending means high interest rates, and the market has ended up pricing that in completely. Now, how this becomes interesting is that, like I said, U.S. bond yields, bond prices were already oversold, and this week's activity has only made it even more oversold, in the sense that sentiment indicators, RSI is down to below 20. Sentiment indicators are showing that in single digits, the number of people who are bullish are in single digits. When you do analyst surveys, so you are like almost 97% or 96% people who are bearish, barely a few percentage people who are bullish, and that usually marks a bottom. And now the wave count for this entire bond market sell-off, like I thought was 3, now is 5 waves, and fits more reasonably into what EWA was already saying, that, well, if you complete 5 waves, then you get a counter trend or bounce back rally. So right now, while people would be panicking on higher US yields, my sense is essentially you've reached probably the bottom as far as US yields are concerned, and you're going to get a counter trend move. Because it's a 5 wave fall, it means the larger trend has turned down, but once you complete 5 waves, you'll retrace 50-60%. Couple of weeks, maybe couple of months. Bond markets are slow moving animals, they don't just move, and so you'll see that bounce back, and only the next wave down for yields and bonds could be maybe a month or two away. And in the interim, that would provide relief to the interest rate risk based thoughts. But here's what you really need to know, and you've seen my posts in the intermarket section on India charts. Essentially, every time you plot bond prices and US equity prices, they are inversely correlated. Moment you take a time frame that runs into a couple of weeks, or you even take a multi-year time frame. So at both degrees of time, you find that they are always diverging from each other, whether it's multi-month or whether it's multi-week. So if you take any of these sell-offs, if you go to even last year's August sell-off, when the Chinese yuan fear occurred, US bond yields were actually falling and US equity prices were actually crashing. Same thing you'll find even in Jan of 2016, when US equity prices sold off sharply, bond prices were actually going up. And that means rates are actually going down. So essentially, rates and US equity prices tend to be directly correlated, and bonds tend to be inversely correlated. And when that happened, gold prices also eventually shot up. They didn't rise too much when equities were falling, but moment equities paused, they took that signal of lower rates to really run away. And so why is that important is essentially, while we always look at the dollar as the key driver of gold prices, the key driver of both the dollar and gold prices often considered the real rate of interest. And the real rate of interest for the US would be essentially the difference between the yields and inflation. So as long as bond yields keep dropping to lower and lower levels, we reached a point where the yields in the last year had essentially fallen below the rate of inflation that the US was reporting. And it's been at that lower end for a while, but it really dropped to a point where it got considered as positive from an inflation perspective. Even though, inflation has different definitions. One is, of course, where you actually feel it in day-to-day prices and in directly measured numbers. And the other is essentially, so it's basically monetary or it's fiscal. So the expectations from heavy spending would be that, yes, fiscal spending leading to real inflation, and the other one is monetary, where a lot of money which is moving from one asset class to another and essentially getting reallocated based on essentially an asset allocation call. So if you want to be out of equities, we do see inverse correlation with bonds, equities to bonds, bonds to equities. And similarly, when you end up with negative real interest rates, you also see equities to gold. And we saw the first round of that last year. And now when bond yields have shot up, so essentially the big jump in yields we saw in Thursday and Friday was the biggest reason you saw the sell-off in gold. And it had less to do with anything else. And moment you see a turnaround in that, once you see bond yields actually start falling again, and real interest rates again cool off, then you'd see the interest coming right back to the precious metal space. But you haven't seen too much of a sell-off in the commodity space, so the inflation expectations remain, but it was essentially the risk of bond yields that's really causing the panic in the precious metals area. Now, what you really need to think about in this whole discussion is that are you really going to get enough inflation that will drive up interest rates? Which is why I said that the expectations of whether the spending is going to be big or small would be an important factor in determining where commodity prices head, because you have the factor of interest rates to manage. And the Fed cannot really afford to move interest rates higher too far, given the size of debts outstanding that now you have around the world and in the US itself. I mean, debt to GDP ratio for the US government itself is at 95% of GDP, and if you put together all the private debt, then of course it's somewhere closer to 360-370%. For Japan, it's already at almost twice of that, and India is of course at a much lesser number of 156%, where the large part now has become private, and the government has slowly cut back its debt load step after step, and probably it wouldn't be surprising that by this year end they actually end up below the 60% mark, which they were slightly above last year. So our debt to GDP at the government level has been falling for more than a decade, year after year, as we've been focused on the fiscal deficit. And but that's not happened with the private sector, which in the last 5 to 8 years has essentially seen their balance sheets expand and bloom. So that's the problem that we face. And for the US, it's a problem on both fronts, because they have huge government debt as well. So they can't raise rates too much, and at the same time, they are taking measures which can be construed by the market as inflationary. But what the market would eventually try to figure out is whether they're going to allow inflation to persist beyond a point of time, rather than not. And when that becomes apparent, then you'd risk actually having big runaway in commodity prices, precious metal prices, and probably a spike up in inflation. If they do try to attack inflation with interest rates, which is what you normally see in other parts of the cycle when debt levels are much lower and the economy is more manageable. And you usually see it with a lag, which is why even if you go back to the 80s, you see an entire period of rising commodity prices and interest rates are raised, but because they are raised with a lag in expectation that the price runaway would pause, real interest rates continue to remain negative, and that is why the commodity prices keep galloping ahead of inflation, till the point that you really get aggressive with rates to really curb negative rates from real rates from really taking hold. So what they're going to do this time around is something that we'll have to watch. But what we do know is that debt levels are too high to really raise rates too far, and which is why it's possible that if inflation really starts to take hold, it can actually get slightly out of control. But at the same time, you can manage to have small levels of inflation. So my net point is that you need to remain open to the possibility that you can have higher commodity prices. The next one is that you can also have a weaker dollar. Right now, everyone's focused perpetually on the potential that the dollar can keep rising. And when I say the dollar will keep rising, is more in terms of the dollar index. But I think there is clearly going to be a break away from what the dollar index does and what other currency pairs actually end up doing. So you'd want to watch that. But if you do get a breakaway move in the dollar index, then of course it continues to put pressure on commodity prices beyond this point. I have shown an example of that, which happened between 1998 and 2001, when you got the second breakaway in commodity in the dollar, and that was actually that breakout actually caused an overall sell-off from the tech bubble to most equity markets. And gold, prior to that, it actually rallied in its first wave, and so it went through a deep retracement, almost retracing 99% of those gains before it started its major move up. So that was one scenario, but increasingly I was moving away from that scenario simply because the dollar index itself has already been through an 8-year cycle. It's risen for 8 years and has been through this 8-year up and down cycle for almost the last couple of decades. So it's all through the 80s, early 80s it peaked, then it was falling, and then it rose through the 90s, and then it was falling through the 2000s, and it has been rising through the 2010s. And essentially it's been through this 8-9 year cycle. I've published a chart on that just last week. And so we are at the end of what should be a 9-year up cycle for the dollar in 2016, starting from 2008. So having done that, we should actually be looking at being at the fag end of what should be a dollar up move. It's also retraced 61% of the entire previous fall. And what tends to happen at the end of a trend is everyone is extrapolating what is going on into the future. So that's what I feel sometimes people are doing. They're just extrapolating the current dollar rise into the future, just like they would probably have been doing for the dollar and commodity space in 2008. They would have thought the dollar can keep falling and commodities will keep rising, and oil went all the way to $150 almost, and people started projecting even $200. So that's what tends to happen at the end of a trend. And somewhere I started getting this feeling that we are overshooting on our expectations with the dollar. Now it's already spent 2 years between 100 and 1.5 years, if not 2 years, between the 9900 mark and the lower end, where we fall into 94, 92, 91, that this range. So this 8-point move, it's been doing up and down for 1.5 years. And this broad range, my sense is, since we are within the 61% mark, unless we really break out of 100, 101, I've growingly moved to the expectation that you'll actually start seeing the dollar fall rather than rise. And this would fit the expectation that you'd actually have some strength in the commodity space from what would be fiscal spending, but the spending may be at much lower pace than most people expect, such that it doesn't drive interest rates completely out of control. So let's see how that goes, but those are the expectations with which I would be working, rather than expecting that things are going to go out of hand. But if inflation really goes out of hand, and the bond markets also give up, that would be a very, very different scenario. But the other one is, like I said, rising bond prices always associated with falling US equity prices. So US equities, which have been rallying from the Feb low, have formed something which looks like an ending pattern on the Dow over the last several months, and the fifth wave, or the E wave, formed right after the Trump election, as the Dow started making a new high, and it may be coming close to completion. So once it completes and turns down, I think you would see the similar inverse correlation: rising bond prices and falling US equity prices. And typically, if US equity prices are going through a decline after an ending pattern, typically a sharp decline, then I think it has a negative impact on most world markets. But in the interim, the Indian market has essentially taken a lead, peaking in September, mid-caps peaking by early November, and we would have actually already started our move lower ahead of the US top taking place. So that's my sense and reading of the entire market related picture. And the last event, I think the last one that has happened this week, has been the very big news on the move away from cash. And I think there have been enough opinions on it, most of them saying short-term good, long-term, short-term bad, long-term good. But we are trying to judge what would be the real size of what will come out of this, but I think decade after decade, we've always heard that the cash economy in India is significant. It could be much more than what is officially estimated. Still, how much would actually come out in the open? And irrespective, because it has a balance sheet impact on the RBI, it has a positive impact for the government. So the government finances would definitely improve at the end of this. Depending on how much money is really directly moves into the banking sector, how much money banks get and to really show better deposits and ratios is something we'll only figure out after a month or two, because while expectations can be good to get a lot of deposits, you can't really be sure how much of money people would, especially those who have large holdings, would really want to move in. Everybody's running around trying to look at ways in which they can actually manage to convert their money into something else, whether it's gold, whether it's dollars. A lot of activity going on looking for people who have bank accounts available to show income. I'm not sure how much they'll be able to do, and then whatever left is not declared. Would you really come out and declare it? Definitely not, given the amount of fines that you could face, and you really don't know. Nobody would really want to come and admit that what they've been doing when they haven't done so in so many multiple VDI schemes that the government has really come out for over years. So essentially, it has that near-term negative impact in terms of the entire demand scenario on the economy. So that I don't think we can overlook. At the same time, the positive effects only come after this entire cycle is complete. And when I say cycle, essentially I'm referring to the quantitative cycle, of course, the economic winter that I've written about for so long. And we've been in the final phases of it, and it also coincides when the entire theory of Elliott wave and its extension into social mood that EWI really has written and spoken about so much. What it says and tries to imply is that when you end something of a fifth wave at a large degree of time, one is of course at cycle degree and one is at super cycle degree. So if I'm looking at India being at super cycle degree, you're looking at a major social mood change, from up to down. And that social mood change essentially ends up voting in favor of things that you probably have earlier ignored. You would have said, no, this is okay, let it be. And then people at large start accepting that change and wanting that change. And governments are the greatest reflection, because they essentially do what public at large votes them in to do, because that's how they come to power. And that's what Trump is all about, and that's what I would think the current measures are also all about. So mood has changed, and the actions which we are seeing, even though they may appear market negative, they may appear economic negative, they are completely in sync with the winter cycle social mood theories. And what that tells us that now we're clearly entering, I think, in the final phase of the corrective decline of what's been a 60-70 year or I should say maybe 8-year bull market for India, going all the way back to the inception of RBI 1934, independence, and so on. And we are seeing the first significant change, market correction that occurs, and once that's complete is when you get the real turnaround into the next super cycle. So the winter ends and the spring starts. So we're entering that phase, and so you really need to be careful, because it affects almost all investments, as you've seen. I think if I wrote about it theoretically, as I've done so many times, you'd probably wonder how is this going to happen. And then when a measure like this takes place, you'd probably just go and blame this event in hindsight as having caused all of which has happened, because in hindsight you'll always find the reasons that caused the cycle to complete. But essentially, what we needed is to actually roll back our debt levels, especially in the private sector. A lot of other problems that we have and we've been addressing with the current government, whether it's been in the areas of corruption or otherwise. And once we are done with all of that is when we'll be able to set the stage with new rules, new guidelines, and a new economy. So all of that is being put in place. All the things that you need for a more serious bull run are being put in place, but essentially you have to also complete the corrective processes. And the reason for that is that if you don't do that, then you end up getting what is a bubble economy. And if you do take the corrective actions, then you get a real boom, and a real boom actually lasts much longer than a bubble economy. A bubble economy could last a couple of years, you get overvalued, you sell off. In some ways, you could say you've seen a bit of that in the in the last couple of years, but it was not. We didn't jump into the inflationary bandwagon, which was an option that this government had, and they didn't take it. Which again is partly got to do with social mood, because the government was voted in uh, uh, with a view against inflation. So that was clearly not the objective. So we are getting there, and I think we've seen now increasing signs that the markets rolled over into the next major down phase. Its impact and things that could happen levels is something that I've discussed in the previous long short report, and will continue to write about in the future reports. But essentially, this event is one that has touched a lot of lives. A lot of people who are affected by it negatively would probably not be happy right now. Others would probably be waiting for the painful stage of waiting for cash to come in to really come back. But everyone's experiences can be different based on how you're positioned. I mean, for someone who's here in Mumbai, you have things are moving in one way or the other. Even if you're short of cash. If you're living in an apartment, you have kirana stores that are running on credit, allowing people to buy things. So not that everything has come to a halt. I've been to a hospital that have accepted checks. I've been to medical shops that have that accept credit cards. So there are all kinds of things that are still working. They even accepted old 500 rupee notes. So well, there are cases where people don't accept it. If the banks are still accepting deposits, there are a lot of people who are taking those old cash payments and going to the bank and depositing it. So it's not that money is not moving, but essentially the biggest pain is for people who hoarded it. And the reason that became so widespread is it's not something that started a year or two ago. It's something that's happened over several decades or an entire century. And the only unfortunate part, which some people were highlighting, is that some of the big money, the ones that have been doing it in the old days and have already moved it out of maybe the country, gone to Swiss banks, maybe even run away from Swiss banks because nobody took action early enough seriously, that it's become untraceable. It may have gone to Singapore, it may have gone somewhere else. A lot of money coming in through P notes was associated with that at one point of time, but not so much is really proven. And because these measures became harder to prove, the feeling among those who've actually followed, thinking that, well, if everybody is running away, not paying taxes, we might as well do the same. What I find is that there are so many people in the professional space who've been putting aside cash and hoarding it over time, and now they're looking for outlets. And these are all small businesses, professionals, in various phases, whether they may be lawyers, doctors, I don't know. All of them taking a hit because they tried doing something on that front, and now they're looking for, they're the ones who were taking a serious hit, but they're not been able to do what probably previous people did previously. And that illicit money which has left the country really needed to be sourced out. There's an entire movement, I think, around the world to find money that has found tax havens and other places to hide, to really bring it under law, and maybe some of those measures eventually help the government to source it back. I don't know. Or maybe you'd probably think at the end of it that, well, that's the super rich money that's really gotten away and nothing's ever going to happen. And so those getting penalized might actually start believing that only they are getting penalized. So that's the kind of thinking that's going through. But all we can think is that this is a one-time cleanup, and once done, it could have positive long-term effects if we are committed towards having new laws and infrastructure which is pro-capitalist and which is pro in the form that it actually involves things like low taxes, because it was the high levels of taxes, things like 70-80% taxation that existed in the 50s and 60s, that drew people away from actually holding white money. So we need to be very clear about our plans of not not really going back there, and that tax rates would continue to decline as we move towards a more clean and open economy. So that's the good news. But it's going to take time, because we're going to go through this hardship in many different ways for each one. For those who are not affected by it in cash terms, they would be affected by it in economic terms, because the economy itself would slow down for a while. And that might cause a slowdown in various sectors. In lending, there's the subprime issue. So that's one more that I think I should touch upon. That if you've read this, you've read about the U.S. housing subprime, but in the current cycle, there's a huge buildup that is happening in the US auto subprime, and that's become another mini bubble of its own. It might not have the size of the housing market, but at almost $1 trillion of lending to autos, you have asset-backed securities, which are auto loans of running of almost $200 billion. And so you have another market which has built that. So it really makes me wonder whether even in India, a lot of the lending boom recently, NBFCs and so on, are moving to smaller towns, smaller cities. FMCGs forming on focusing on smaller towns, smaller buyers. And all of that essentially points to one thing, which is subprime. So I wonder, and you'll really come to know that to what extent a lot of the new loans and this entire NBFC boom is essentially associated with subprime loans, or loans to people who had more cash allocations than hard earnings. And that entire thing can have a huge negative impact on the economy and those particular sectors in the near term. So that's what you really need to watch out for. But like I said, at the end, then once we've been through that pain period is when things will get not just better for a short period, but for very, very long time to come. So I think that that almost rounds it up. The key takeaways are that the IMF has been talking about fiscal spending. It may come slowly for the US at some point of time, and they're going to try and fight doing that without inflation. But you're going to get some inflation. So you have to be pro-inflation. You can't be anti-inflation. And second is India itself, because the government debt to GDP ratio has been falling for more than a decade. The biggest spender, the one that is going to drive the next round of growth, is going to be the government itself. It won't be the private sector that will first have unwound its debt, and only then will be able to borrow into the next cycle. But the government, which would have already unwound all its debt, would be in the best position to start spending and growing this economy at some point of time. And whenever it does that aggressively, definitely there's no way that growth will not bounce back. The question is only of when. Most world markets right now remain in a lull. Unlike our market, they haven't reacted, but I guess they would react most to when probably the US markets react. And I've already spoken about how they would react to bond yields. The other factor that they may react to is, of course, what is happening in Europe. You're going to have all these referendums coming in one after the other. And a lot of those could, actually be several rounds of negative news for the Eurozone and the European economies. That I think would be seen as a risk in various asset classes, especially equities. So those are the things that you're going to be watching out for the next couple of months. It's not going to be an easy ride, but it clearly looks like a move that may have turned from up to down. You'll keep getting more and more confirmation of that as this move goes along, but essentially so far you've broken channels, you've broken averages on the weekly levels that typically held in the whole extension move that occurred in 2015 and the overextension of the broad market this year. So that's all for me in this update. I think I've covered a lot. This is a long video, and I think I shall end it now. Thank you for listening.